stocks continuing to hit record highs during the first half of the year, despite lingering concerns around the economy, the Fed, and geopolitics. Let's talk about what the setup looks like in the second half of the year. And I have Scott Helfstein here sitting with me, head of our investment strategy here at Global X. And Scott, it's great to see you.
Good to see you, Seana.
So let's talk about where things stand right now. It was just 6 months ago. You and I were sitting here in these chairs talking about what to expect for the entire year. I'm curious where things stand right now, the record-setting numbers that we have seen in the first half of the year. What was the biggest surprise to you?
I think it's that our prediction for the year, the real central organizing principle of the economy, continues to be the automation revolution. And we've actually seen it accelerate, and companies are delivering record profitability. So we continue to really like this setup, and we think that there will be more investment into automation, including artificial intelligence, as we go through the year.
So Scott, then looking ahead to the second half of the year, and you frame your market outlook, the mid-year outlook, through Newton's laws of motion. I'm curious why it's so relevant for investors given where we are today.
Newton states that an object at rest stays at rest unless acted upon by an unbalanced force. An object in motion stays in motion. And we think the economy and the markets broadly are in motion right now. And we say that particularly in the economy because we've now seen successive quarters where nominal growth has continued to accelerate. And so we're now running between 5 and 6%, which is a pretty healthy clip for the US economy. But we also now have a new Fed chair and an inflation picture courtesy of the Iran conflict and energy prices that's gotten more complicated. So we think over time that a new Fed policy focused on a smaller footprint in the economy is generally positive, but it's going to take a little bit of time to get there. So the question as we look through the back part of the year is how fast does inflation go down? We've seen energy prices drop very, very quickly as the straits reopened. And if that filters through supply chains, then that's a positive. And perhaps the Fed doesn't have to act against inflation as aggressive as the market is expecting.
But Scott, if we don't see that happen, is that the biggest risk then to the economy being in motion, or how are you thinking about that?
So there is some risk involved if inflation doesn't slow quite fast enough, but there already now are 2 rate hikes priced into the market for this year and one for early next year. So I actually think it would just be more upside if inflation does come down, but that soft patch we went through looks like it's over. And so it seems like the market is a little bit more confident. But it's, again, this balance between labor and inflation.
Scott, let's move to Newton's second law and talk a little bit about force, because in your outlook, you talk about really the force in the market this year has very much been strong earnings and it's been margin expansion. As you square that with this risk here, or maybe uncertainty is a better word, in terms of what the Fed's plan or policy is going to look like moving forward, how does that square then with some of that momentum and the strength that we have seen in corporate earnings?
So strong earnings have really been the story of the year. They've been revised up for the S&P 500 from $316 a share to now above $340. That's an 8% increase. That pretty much captures the entirety of the advance in the market. So we've actually seen earnings expectations revised higher, and we've seen multiples compress a little bit. With record margins, I think there could be further multiple expansion to come. It's a little bit of a prove it moment. So we really like this setup. And if in fact we get this 15.5% profit margin, we could see 23 times, maybe even a little bit higher. Markets do tend to overshoot as we have good news. So we're very much focused on the fundamentals. And it wouldn't also surprise us if we really see a little bit of a bifurcation where those that deliver on their expectations and can hit their guidance really drive the market higher, and maybe those that stutter a little bit against some of the challenges in the economy are less loved.
And Scott, that very much has been a lot of the narrative and talk surrounding AI specifically, and some of the winners that we have seen in this space versus some of those names that have been beaten down a little bit over the last several months. I want to dig into some of the themes that you call out within the mid-year outlook and start with the AI trade and what you call the virtuous AI investment loop. It's one of the major themes that you're focused on. Unpack that for us and why that's so relevant and important for investors at this point.
AI essentially is automating cognitive tasks at a very, very rapid rate. To support that, we need to build infrastructure. And a lot of that is the hyperscaler spending, but it's more general across the economy. So what we're seeing is investment that is going in, and we've seen significant investment growth and areas like infrastructure and materials that are benefiting. But the investment growth is really driving that productivity boom. And so as we spend more money to improve our capacity to put more online, we're actually then seeing it paid back very, very rapidly in the productivity increases. And one of the areas that we're going to continue to look at isn't just the large cap, but watching those productivity improvements trickle down to mid and small cap, where it's a lot harder to invest in those resources up front. But as we start to see margins improve in that segment of the economy, I think that that's really the prove it moment.
Is that an overlooked area of the market?
One of the challenges market structure for small caps has changed as more and more companies have gone private. So the incorporation of the technology, I think, is really important. So it's not necessarily an area that we would run towards aggressively, but it's one that we're watching and that we expect to improve over time.
So, Scott, as we're talking about opportunities within the market, when you take a look at the fact that the markets have hit record highs during the first half of the year, I think many investors will look at it and say, almost everything feels expensive right now. But that's not necessarily the case. Where are some of those compelling values in the market today?
So, one of the areas that we think investors should be focused on are traditionally cyclical stocks that are increasingly secular. So, for example, take something like infrastructure development. Typically, it ebbs and flows with the economic cycle, but with the amount of capital that's being invested to build data centers, and consider the fact that there is a ton of construction that has to go into these very big facilities. And what is it? It's things like engineering firms, heavy machinery, materials. So it's an area that we traditionally treat as cyclical, therefore has a lower multiple, but going forward is probably more secular in nature. Similar to that, material stocks. Materials only represent about 2% of the S&P 500 index. And yet, if we think about the inputs that go in, so think about areas like copper, lithium, rare earths, areas where we've seen price increases because there's supply shortages. And yet we require those to continue to build out this automation and AI infrastructure. So a lot of what we've seen in terms of returns is really more about the earnings this year than the multiple. And so it's an area that's not particularly expensive. If we also want to think about not just the physical things that go in, but the digital picks and shovels, for example, something like cybersecurity, where the more that we build proprietary software with new coding tools, AI coding tools, the more we need to protect not just our data now, but the software that we are entrusting to help drive productivity and make decisions. And then keep in mind that there's probably still opportunities in the core of the AI trade. And what do I mean by that? Data centers. So while there's some uncertainty around software, data centers have largely been at record low vacancy rates, record high rents. And where are we seeing challenges across the supply chain for the AI buildouts? In memory and storage. Who owns memory and storage? A lot of it. It's the existing data centers and their suppliers. So there are still a number of parts of the market and themes that we like going into the back part of the year.
Scott, there's so much for investors to consider right now. And as we wrap this up, I want to quickly touch on geopolitics. And this is tied to Newton's third law, which you highlight. I'm going to read it. It's that every action has an equal and opposite reaction. So, of course, the question here is, how does that then apply to today's geopolitical environment?
So the markets have been very resilient to what is quite high policy uncertainty, which is pretty unusual. The first half of the year has been largely defined, we would argue, by large unilateral actions by the United States. We can think about Venezuela, we can think about Iran, we can think about some policies around trade. We think that the back half of the year going into midterms is going to be more about some negotiation and compromise. So it wouldn't surprise us to see maybe a calmer geopolitical environment. Keep in mind that at the midterms, we do tend to see when unified government, one party that controls the executive, the House, and the Senate altogether, gets broken up, that markets rally pretty strong after that. So we expect some lingering geopolitical uncertainty as we go through into the back half of the year, certainly with midterms ahead, but perhaps not quite as vibrant as we saw in the first half.
Yeah, and Scott, I'm curious just to get your take on investor reaction to the various geopolitical developments, because yes, in one sense, it has very much been headline driven, and we have seen large swings either way. But I think you can also make the argument that investors have largely shrugged off some of these concerns. Is the market getting it right, or are there some risks that investors continue to underestimate?
I think the fundamentals and what is ultimately driving the economy, automation, AI, improved productivity, warrant a degree of resilience in the market. But I also think investors should be careful about becoming too complacent, and therefore, think strategically about where they want to invest for the back part of the year.
Makes a lot of sense. Scott, great stuff. Thanks so much.
Thank you, Seana.